We came into the year thinking the markets would sell off, Scott, and holding some extra cash. And while we don't think the worst is behind us, we definitely think there's stocks to buy today, and we'd spend about a quarter to a third of that cash today. As global growth and negative rates will eventually carry the day, and we also think that Powell threads the needle, controlling inflation and not doing too much damage to growth, and markets are doing some of that for him already.
Steve Weiss, I got 78% of the S&P down 10% or more from 52-week highs. I've got the ARC complex down today by some 8%. Kramer at 10:34 this morning, so about an hour and a half ago, says 9-1 down. And maybe it's a little bit to Rob's point. Must buy even if you hate it. Hate in all caps. How do you see the market here, Steve?
You know what? I hate losing money worse than I hate missing a stock that may rally 5% from here. I'm still negative. I sold a little bit more this morning. I came in, with a boatload of cash and being short the indices, which I mentioned on Friday, and some other names, high price names like Roblox. I don't think we're done yet. And what's most troubling is now we're seeing numbers come in, economic numbers like the PMI that came in a little light today. We're seeing that in Europe as well. So we're not there. You can have the worst of both situations here, which the Fed has to control inflation, has to raise rates. Yet the market, if you take a look at the bond market, it's telling you the economy's slowing. So you have rates going up while the economy is going down. That's not a great combination. So I prefer to stay in the sidelines, and I'd like to see the market consolidate before I start putting cash to work. I'm in no hurry.
Bryn, how much more pain do you think we have to endure before you feel comfortable buying some stocks? If not, now being the time.
I mean, I think that, well, first of all, the market is doing the Fed's bidding. And so, the irony is the Fed is still buying bonds and quantitative easing, but the market is priced in not only 4 rate hikes, but I feel the market's priced in a really hawkish quantitative tightening. I think that what's not priced in, and Steve talked a bit about it, and so did Rob, is that ultimately growth could slow this year, which with the market already bursting this bubble in high growth names or calling it a crash in these high growth names, what have you. I think that at these levels in the high growth names, if you're not looking at these high growth names, the real ones that are going to be sustainable, I think you're going to miss out on a big opportunity. And so, we obviously own ARC. We have a position in there. We're looking at that technically to see a good entry point. But I do think that when no one wants to touch these, when no one wants to own them, there are some really good companies that are not only going to survive this, but thrive. But it doesn't feel good today. And this is typically these kind of markets where you have to kind of close your eyes, plug your nose, and do a little buying.